Do you agree with Ray Dalio that maybe we're overplaying the trade war threat?
Well, yeah, I think for the time being I would agree for two reasons. One is we're not in a recessionary window of vulnerability, so I don't think it's a real huge risk at the moment. And you know, my mom's from the show me state of Missouri, and this could be a lot more bark than bite so far. And when you look at the details of what's been proposed, it doesn't really account for that much trade. It's on the order of 1 or 2% of global trade. And when you look at the U.S., I mean, there are some trade issues, right? Our non-petroleum goods trade deficit blew out to its worst reading ever in Trump's first year. So he's feeling the pressure in some sense. But when you look at what's driving that, it's China and Mexico. It doesn't have a lot to do with steel and aluminum and things like that. So
we may be focused on the wrong thing.
Well, so maybe it's a negotiating ploy or something, like Ray was saying. You know, that's fine.
Right, which would not be out of the realm of possibility.
Not at all. I don't think this is a huge deal at the moment.
Okay, so not a huge deal, but still, Lakshman, according to your data, and I want to pull up a chart here, G#BTV 4311. You say by some of the measurements you're looking at, we are in for a global slowdown here. Is that right?
Absolutely. Well,
can you explain this chart here?
Sure, absolutely. Well, we've been saying since the fall that our forward-looking data was pointing to a global growth slowdown, a synchronized global growth slowdown after having forecast the upturn last year. Now, that's no longer a forecast, it's a fact. This chart shows GDP growth, and this is quarterly annualized GDP growth for the three largest developed economies. The U.S. at the top, you have the Eurozone in the middle, and Japan at the bottom. And you see that they've already begun to roll over. GDP is looking in the rearview mirror. That's not looking ahead. It's already happening.
Okay, but if that's the case, I want to pull up another chart here, Lakshman, G#BTV231, which shows you that, in fact, asset managers who have a longer-term horizon, they continue, and this is represented by the blue line, they continue to bet, though, that yields are going to back up here in the Treasury market. So they seem to look and say, look, the longer-term growth means more inflation, and the economy is going to continue to expand. Yeah,
well, so in the Treasury market's a little tricky because there's some supply and demand issues that are going on, which may argue for higher rates. But I think to the extent there's an expectation of continued synchronized strong growth in 2018, the markets will be disappointed. I'm already seeing Wall Street kind of notes, research notes, starting to come out, picking up on this global growth slowdown. I think you're going to see more of that. And when you look in the bond market, I think the bond market has a lot of information in it. Go away from the Treasury market, go into the corporate bond market, and look at BAA corporates, which is investment grade corporates, and junk. And the spread between the two is very telling. It's very economically sensitive, and it's been widening for many, many months now, totally consistent with a slowdown call. So I think that there is a lot of evidence, and in fact it is growing, that the global slowdown call that we made is the correct call. And now what'll be interesting is that the central banks, the policymakers, they're lagging behind Wall Street a bit. They're still full bore on tightening mode. We got to see Jay Powell last week, and he was a bit more hawkish than expected. And Kuroda came out, and he was a little more hawkish, or not hawkish. He said maybe we'll end QE.